You probably saw the headline this week: mortgage rates at the highest since August. It made the news yesterday. It's also wrong. Or to be more accurate, it is last week's story told late. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. This is your weekend update for May 29th, 2026. Here's what actually happened this week. Rates went down, not up. The 30-year conventional finished Friday at 6.56%. The 30-year jumbo at 6.68%. The 30-year FHA at 6.10%. The 30-year VA at 6.12%. All four ticked lower than where they started, and all four are off the highs from last Friday. National averages from Mortgage News Daily and not an offer to lend. Here's why the headlines got it wrong. The two biggest weekly rate surveys, one from the Mortgage Bankers Association on Wednesday and one from Freddie Mac on Thursday, both report a trailing 5-day average. They're telling you what rates did last week, not what they did today. So when the news yesterday said highest since August, it was technically accurate about the survey and completely wrong about the actual market. By Friday's close, rates were back near the lowest level since May 14th. The chart and the headline were telling two different stories. Now, let me tell you what actually moved the market this week. It's the same story that's been moving rates for 3 months: the Iran peace memo. The U.S. and Iran are reportedly close to agreeing on a one-page framework that would end the war and start a 60-day countdown to a permanent agreement. Markets have been talking about that memo since early May. The underlying details have not really changed. What is changing is the market's sense of how close that memo is to being signed. Every time a new report hits the wire, the bond market reacts a little more. This week, the 10-year Treasury slid 4.45%, or slid to 4.45%, and mortgage rates followed. Yes, it is deja vu, but the market's sense of incremental progress is technically something new. That is the part the headlines miss. The economic data added to the move. Core PCE, the Fed's preferred inflation gauge, came in at 3.3% year over year. Q1 GDP was revised down to 1.6%. Both readings tell the bond market the economy is cooling, and that is the environment where mortgage rates trend lower. If you own a home, here's the question worth sitting with. The latest survey of 150 of the country's leading economists puts the median forecast for home appreciation at 2.5% over the next year and 14% over the next 5 years. On a $500,000 home, that's $12,500 in year one and $70,000 over 5 years. Most of it tax-free. The headlines do not lead with that number. They never do. But that is the wealth your home is quietly building while you sleep. If you're thinking about buying, here's what the housing data showed this week. New home sales came in at 622,000 in April, down 8.8% from last year. But existing homes were up 1.01%, building permits rose 5.1%, and builder confidence jumped 8.82% in May. Translation: the market is not booming, but it is not breaking either. It is shifting under your feet, and the people who move with intention are the ones who win. Here's a part of the data that deserves your attention if you're running a household. Americans pulled $133.9 billion out of savings in April just to keep up with bills. The ratio of consumer interest payments to savings hit 97%. That matches the peak of the 2001 recession. We are not predicting a recession. We are reading the gauges. And the gauges say this: if you're carrying high interest debt, the cost of that debt is quietly eating the cushion you were counting on. That is where strategic debt management starts, not with the lowest rate. With the smartest structure, strategy beats rate always. We have built a complimentary suite of financial illustrators for you and your family. The Rate Reduction Illustrator shows you exactly what it takes to get your current rate to the rate you want. The Purchase Target Illustrator shows you what a home actually costs each month, all in. The Cost of Waiting Illustrator shows what hesitation actually costs in real dollars. If you'd like access to our complimentary illustrator suite, just ask. We also shared 4 featured articles this week, and each one is built around a real-world decision a household is making right now. The first is how one homeowner went from 2 price drops to sold above asking. The second is every day your home sits on the market, You are paying to lose money. The third is the real target of your teen scam isn't your teen. Most parents never see it. The fourth, how would you feel if your first car quietly cost you your first home? There are several on the right side of the dashboard or below the video, depending on the device you're using. One more resource for your household, KeySteps is a free platform offering credit monitoring, identity theft protection, and household budgeting tools all in one place. Visit rsrlinks.com/keysteps. One quick look at next week. The market is watching one report. Friday morning brings the May jobs number. The forecast is 96,000 new jobs and unemployment holding at 4.3%. That report sets the tone for where rates go next. That is your weekend update. We'll appreciate you watching, and we'll speak again next week.